Welcome, welcome, welcome. I am Jonnita Stanton. We have Reginald Perryman, Kashka Williams, and we are TSARE. This is a There's Something About Real Estate podcast where we talk all things real estate. And we have with us today our special guest, Billy Slobin from Supreme Lending.
That's right. Thank you for having me. Super happy to be here with you guys.
So y'all want to know how I met Billy?
I would.
All right. So Charles, I was looking for another loan rep, and Charles was like, you ought to try out Billy and Jake. And I was like, who is Billy and Jake? So he introduced me, and I was like, a lot of times we meet mortgage reps, and we don't really want to start working with somebody new. So Charles showed me like this spreadsheet of all the clients he sent to Billy, and they had like updates on every client he ever sent. And then it was another update. And I was like, damn, that's how I do my business. So just their follow-up game. So that's why we started doing business.
Oh, nice.
It was all because of that follow-up spreadsheet.
Serious. Showing he was organized.
Yeah.
Yep.
A lot of LOs are not.
Right.
Yeah.
You know, and in the last few years with the influx of young talent into my office,
Right.
both of my sons have become much more prevalent. I have another young guy, and they pretty much keep track of everything so that I hammer on our leads that our realtor partners get us, and very often we'll pre-approve somebody and bounce them back to one of our partners who's like, who's that? I'm like, well, he's from a year ago.
Oh, okay.
We're not perfect because, people get sent to us and then they ghost and disappear.
Right.
But we try to put every single one of them in our system, and I'm a relentless person, and so are my guys, and we pound them. And some of them just poof, go away, whatever. But all the time, we'll have one pop back up that we finally fixed their credit, we finally got their docs out of them, and send them back to our partner. And very frequently the answer is, even for organized realtors, who's that?
Right.
So that's a dude from a year and a half ago.
Right.
And we got it to work.
Cool.
It's great. It's great.
All
Very
right.
fun.
Yeah.
Okay. So I would like to hear a little bit about you and your company and how you got started. But when you do it, lean in a little bit so we
Okay.
can hear you in the
It's
microphone.
easy to lean back in these
Okay, yeah,
chairs.
it is.
Very
Very
comfortable
comfy
chairs.
Okay, so how I got my start period in the business?
Yeah.
Okay, so here, I'm going to make it as short and sweet as I can. I was a bouncer and a DJ in a club in Farmington Hills back in 1984.
All right.
And I was going to school and working and coaching football, and I was 21 years old. Bumped into a guy who came into the club all the time, and I used to let him play little records and hang out by the DJ booth. And when I had to bounce somebody, I would let him help because he was a former Country Day wrestler, and he really wanted to be in on the bouncer part of things.
Right.
So he was.
Wait, hold on. You were the bouncer and the DJ?
Right.
Well, here,
That's where
it
I
was a
stuck
small
at.
club, not a huge building, very famous place.
Wait, you want to know why that's funny? Because in '84 you were still using vinyl records.
Yes, I was.
So how many times did the record skip while you was kicking somebody?
Well, not too many times because I had a lieutenant. I had a dude who I would tell, take over.
Right.
The bar wasn't huge. It was a
Okay.
very famous bar, McFrock's.
Okay.
Google it. It'll show up. It was one of Playboy magazine's top singles bars in the nation, a few
Wow.
years running.
Okay.
It was at 12 Mile and Orchard Lake at Farmington
Okay.
Hills.
All right.
So I got a job as a bouncer there. And a couple weeks later, the DJ called in sick, and he was boring and not very good at his job. They said, can you play records? I'm like, am I allowed to talk? They said, sure you can. So I said, okay, I'll play the records. I said, but I still get the help if somebody's got to go, right? They're like, sure, no problem. I mean, not a giant-sized bar. So I went, became the DJ. I talked, of course, and you put it on the Gap band, you drop the bomb on me, 18-minute version, and you can go bounce anybody. And, Prince controversy, 8 minutes. I had a lot of songs that when there was trouble, I'm like, okay, play this record and this record. That's 25 minutes. In that amount of time, we can get rid of anyone.
Yeah.
Right.
So this guy used to hang out, and he wanted to be, he wanted to be around the records, and he was an older guy, no, he was probably 40.
Right.
This is 35 years ago, right? So one day he says to me, and Billy, why are you working here? You have a bigger future ahead of you. What do you want to do? I said, I don't want to do anything right this minute, man. I'm 21. I'm having a good time here. This is great. I'm coaching football. He said, you need to be a salesperson. I said, where do I need to be a salesperson, Ron? He says, well, I have a mortgage company and a real estate company.
Wow.
I said, so what is your real estate company? And he says, well, it's Century 21. I said, I don't wear yellow sport coats.
That was the thing.
Young, cocky guy, right?
Right.
I don't wear yellow sport coats. He goes, well, go to my mortgage company. Here's a business card. I'll go see the guy, give him a call, blah, blah, blah. I go there and meet him. And I'm really not here to trumpet other mortgage companies.
Right.
But the guy was Dan Gilbert.
Right.
Rock Mortgage, 12 Mile and Telegraph, and this is 1985 now. I go meet him. He hires me. There's probably 7 or 8 people working there in total. And after a very short period of time, I figured out this is for me. I like this job. And it was so much different back then. No social media, no processors and closers had some sort of archaic computers. I remember we got our first fax machine. I mean, you're talking, this is a different era. Loans had to go to committee.
Right.
Loans had to go to committee when the underwriting package was ready, the file, and you would wait while it was in committee for a day, a week, a month. So this is, way back when. I worked at a couple other companies over the years, which it would take up this whole, my journey would take up this whole time, so we don't want to do that. Long story short, I love the business, stayed in it, never had one break of 1 second or one doubt of ever staying in it. Right. And have had such a great run and a great time. Just getting warmed up. A couple of years ago, my group, which consists of really about 40 people in a couple of different offices around the metro area, went from being a Mortgage One franchise to a Supreme Lending franchise, which is a large outfit out of Dallas. And they are, in my 36 years of experience, so much more efficient than anybody else. The back shop of a mortgage company should not be the source of grief or stress. They should be a backbone that makes things happen for you, for your clients, is quick, efficient, and concise. And that's what they are.
Right.
I have a question.
Yeah.
Before yours, because
Go
I'm
ahead.
going to go backwards a little bit.
Yeah.
So 2 questions. So we always do school or no school. It's like it's becoming a thing here. Did you do college?
Well, I did for a while, but I spent more time in the parking lot and at the bar at Chi-Chi's in Dearborn than I did in class. I did go to college for 3 years, actually, and the problem is I like music, I like history, took history of rock and roll, history, political science, but if I had to go to anything, math, science, I would just skip.
Right.
Wouldn't go to the things I didn't like.
But
What?
on that, because your boys went to
sons.
college,
Yeah.
'cause your 2 sons work for you.
And are
They're
both
on the
college,
team.
and they're both college graduates.
grads.
Oh, yeah.
I sat
And
down
you
with,
coached them, right?
who was that, Jake?
Jake and Steve.
I sat down with Jake, I think. That's the younger one.
He's the
right?
younger of my two, yeah.
Yeah.
And he was talking about, college and then how he decided to just, I want to come in and do the mortgage loans. And he ran the math and he was like, why would I? Because he was going for law, right?
He wanted to be a lawyer.
Yeah.
He did criminal justice at Grand Valley with an eye toward being an attorney. And then he figured out the math didn't work.
Okay.
Wow.
I mean, I told him, go be a doctor, lawyer, Indian chief.
Right.
You don't have student loans. You're educated. Go do something. He goes, well, I've been thinking about it, and our life is not so bad, so I think I'm going to be a mortgage guy. But
Okay.
he did work with me all through high school and college.
That's awesome.
He would come home every summer, and he was into it. He liked it, and I guess it suited him.
Yeah.
Having your sons work for you, I mean, you can trust them.
It's time for you guys to meet with my boys again.
Okay, love to.
So my number 2, and then I'll
And
sorry.
go ahead.
Because you've been around long enough, when they rolled out the mandate that the LOs now have to be licensed.
I started dancing and singing.
Right.
I was the happiest guy of all because
Right.
I wondered and railed about why do I have to, and compete's not a fair word, but why do I have to deal with potential clients talking to people who sell ice cream, shoes, work at a dry cleaner, being a fake loan officer when they're not licensed. All these years, I'm telling the truth, being honest, doing things the right way.
Right.
And there's all these people out there. Every time rates go down, they're jumping in, they're causing trouble, they're doing crappy subprime loans, they're wreaking havoc. So when it all came down, And they said, here's what's going to happen. Here's this. I saw pieces of the whole picture that I'm like, well, that's probably not the best way to do that. But simple fact that you had to pass a 125 question test to get the license. I was like, yeah, man, give me the test.
Right, right.
And it knocked out between the economic fallout of that era, 05,
Yeah.
06, 7, 8, 9. People think it was 08. It started back in 04,
05.
05.
Yeah.
When I
Across the
started
room.
seeing, appraisals coming in low.
Yes.
We saw what was happening. Knowing that 70% of the fakers were going to get pushed out of the business.
Yeah.
It's the greatest thing that ever happened. And people were, I even knew some actual real loan officers who weren't big producers who were like, oh, I don't want to have to study and take that test. I sat down in the back patio with my wife with a big glass of vodka, the workbook and a highlighter. She said, sweetie, don't you, and the music on, of course, because I don't ever not have the music on. She said, sweetie, don't you need some peace and quiet in the library? I said, give me the test today.
Right.
Give me it now. I don't need anything. The test, they say, 3 hours. I went to the place where they make you get naked, give up your phone. I got nothing on me. I was out of there in like 50 minutes.
That's awesome.
Bing, 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 bing. Go back and check your stuff. That's just the way I roll.
Right.
I move fast.
Right.
I remember thinking, it's going to be so much easier to do our job without a bunch of people handing out bad information. It wasn't that, this guy might have a lower rate or this guy might have this. The general population, mortgages and or realty is not what they do all day, every day. So somebody who's not totally honest and is just throwing it out there, back in those days, they wreak havoc. They misled a lot of people. How do you think so many people got into so many bad loans and all this bad stuff happened? It wasn't from good guys that are still in the business. It's some people who were just out trying to
That's true.
make fat. It was done. It was perpetrated by crooks and charlatans.
Right. Yeah,
Okay.
makes sense. Because we're still seeing some of that now, like even in real estate. Anytime the market is extremely good, you start seeing people get in it that probably wouldn't normally be in a business, right?
We
so
talk about it all the
everybody
time.
want a piece of it, right?
I said the fakers, the people that
Exactly.
say
And they're not in it for the right reasons. They're in it for a fast buck. If you're in it for a fast buck, and let's face it, we're all on commission.
Right,
I like to make the money,
right,
but I'm in it to lead people in the right direction, take care of people, and making money or some amount on a transaction is nothing compared to having somebody trust you and refer all their friends and relatives and so on to you. It's a whole different focus.
right. And one thing too, I noticed like with Billy, like anytime somebody on my team writes an offer, Billy will call the listing agent. And they're like, oh yeah, you good, you working with Billy, right? So when I see his name on my listings, I'm like, okay, I know the loan is good. Now let's focus on the offer part.
Right.
So that makes a huge difference. Yeah. All right, so go ahead.
No.
You want to get into some of these questions
I do.
that buyers need to know?
So we just did basically like this episode where we did, some rundown for the buyers. But, we're mostly in here kind of just chit-chatting back and forth. So we're so happy that you're here because you're going to, present some facts, right?
Yes, I am. Yes, I am. You tell me which ones you want, and I'll give them to you.
Credit. I want to talk about credit criteria and how important it is. Not like the hard scores, but those scores that when you see it, you're gonna get an automatic acceptance and we can move forward. So that doesn't have to be a 800, but it doesn't have to be a 500 either.
Correct. Okay,
Right.
so to take it back a little bit, back in 08 or 09, you see, for the first many, many years, scores really weren't the thing.
Okay.
They would look at a credit report. This is probably pre 2000 into the early 2000s.
Right.
They looked at the credit. There wasn't FICO scores on a credit report that were mandatory criteria for loan approvals. They would look at their credit history because the underwriting wasn't done automated back then. That only started in the late 90s, early 2000s, automated underwriting, which had to pick up a score. So as the 2000s proceeded, the scores became more of a benchmark of what loans got through and what loans didn't. When the world melted down in pick your year, 06, 7, 8. There came a time where they said, okay, anything under 640, done.
Yep.
Doesn't matter. Don't care what your excuse is, what your reason is. 640, hard, fast. FHA or conventional. To get a conventional approval with a 640 back then, you had to be putting 10, 15, 20% down, have reserves, meaning money left over in the bank. And FHA, your file was just automatically dead under 640. Middle credit score. Let's emphasize credit score. The credit score doesn't strictly mean TransUnion, Experian, Equifax. It is the middle one numerically. Client emailed me today and said, which of my 3 scores needs to be is operative? Which of these 3 companies? I said, it's not the companies. It's which one is numerically the middle of the 3. Okay. So, as time went by past the meltdown, things got a little more loosened up, I guess we should say. And there's criteria that's best put is on a sliding scale. Somebody says, what's the minimum credit score? Okay, well, the minimum credit score on an FHA per HUD is 580.
Right.
Now, will a 580 get approved? Not unless they have money. Not unless they have money. They have to have, number one, a 580 has got to be a result of old crimes. It can't be the last 6 car payments were late.
Right.
Because that's not going to make it through the audit. It's still got to go through the automated underwriting.
Right. So when you say a result of past, so past delinquencies or something, like maybe that was 2 years ago, something that brought their score down.
Things that they did that haven't healed, wounds that haven't healed all the way yet.
Right.
But yet things are not past due anymore.
Right.
I just got recently somebody with like a 590, 588 approved, but they had their own down payment.
Right.
And they had 80 grand in a 401k.
So maybe somebody credit was beat up, say 2 years ago. And, something happened, their score dropped below 580.
Yes.
It may increase to 580, but they got some money, but they've been current in the past 12 months.
They've been current in the last 12 months.
Okay.
They have job stability.
Right.
They work at Ford. They work at Chrysler. They have some money in a 401k. They have a bank account with enough money for their 3.5%. There's got to be some good things about the file to get a low score like that through.
Right.
When people come to you and they have a 580, if they want down payment assistance, if they're just trying to squeak it, it's not going to work.
Right.
So, but in that credit score range, the lower tier, is that automatic approval?
Not automatic. It's not automatic unless the computer picks up positive aspects about the file.
Okay.
Savings pattern, job stability, debt to income ratio that's not pushing it.
Mm-hmm.
Right.
Now, if all those things are the reverse, now are you is that manual underwriting?
You can't get a manual at 580. You probably can't get them. Each company has their own rules at what level they'll do a manual.
Okay.
Most companies don't want to do a manual under 620.
So in other words,
so the 620 is your like sweet spot.
It won't go through automated underwriting, but yet there's good things about it. You input it, you run it through. Computer doesn't like it. If you're 620 and have positive things you can point out to an underwriter, a manual may work for you. It's not super common.
Right.
What underwriter wants to sign that?
So it sounds like the lower the score, the more skin in the game the buyer needs.
Yes.
And the cleaner their file has to be maybe in the past 12 months.
Yes.
So they can't get all the incentives that a buyer maybe with like a 640, 700 would get.
Even 620, there are down payment assistance products that we have that begin at 620.
Right.
But you can't have any lates in the last 12 months, especially for that 620 to 640 range.
Okay. So basically, if the credit score is here, then you're going to have to use a lot more of your own money.
Your own money, yes.
So most of those like down payment assistance, the zero down programs, or any of those incentive programs, you still need a higher credit score.
Yes.
Maybe 640 or better.
Yes.
For it to kind of work.
Yes.
Okay.
We have a product that begins at 620. They get down payment assistance, can have no lates in the last 12 months. And if they pay their payment on time for 3 years, the down payment assistance, which is 3.5% of the sales price, equivalent to an FHA down payment, is forgiven.
Wow.
It's beautiful.
Okay.
Yeah.
Right.
Next benchmark, 640, same forgivable 3.5% down payment, but some other better rates, the higher, risk-based pricing. The higher the credit score, the lower the rate.
Right.
The state of Michigan, their Mishta product, which we happen to be knowledgeable on and do quite a bit of, their 640, no exceptions for their FHA version of their down payment assistance product that people hear a lot about, $10,000 in many zip codes,
Right.
$7,500 in other zip codes. And then over 700, you can do a conventional Mishta, which is a very good product. We
Right.
probably did 2 of them today. But again, to get a conventional Mishta, the computer's got to really like you.
Yeah.
The 700 is not the only criteria. That's the ballpark in which you have to be. And that is a very important product because people who want the down payment assistance, who want a condo, and as we know,
Yeah.
a needle in a haystack is a condo that's
Yes.
kept their FHA certification.
Right.
So you have to do conventional, which means they got to have over 700. And even though they're going to get that down payment assistance, they have to have some money.
Can you?
I want to translate that.
I want
real
to.
quick.
Yeah, that condo.
Yeah.
Yeah. So, can you explain
Yes, I
quickly
can.
why condo, FHA, or conventional? Because
Yes.
we see a lot
This
of
is a
condos,
huge thing.
And I break
and they
so many
won't
hearts
accept
on that.
FHA.
Okay, yes.
Yeah.
And we try to break them up front.
Right.
Yes.
We tell them when we pre-approve people, this is not for a condo
Mm-hmm.
unless your agent can do a needle in a haystack, which is what
Right.
it exactly is. Okay, so condos. Condos are unique and different in their financing because there is an association and a homeowners association and a management company, and there's insurance, there's fidelity bond for bond board members stealing, there's budget for mandated repairs, there's so much deep paperwork regarding condos that and we keep going back to the same time era
Right.
in 2004, 5, 6. Prior to 2004, 5, 6, condo boards, condo associations kept up their paperwork with HUD. And when I look back at my old database, my old files, we did tons of condos FHA back in 86, 88, 92, 2004, whatever it was. We did them all the time. But when the meltdown came, for a couple reasons, I'm guessing, so many of the associations stopped keeping their paperwork up to date with HUD.
Right.
Now, I'm sure some was a function of a skeletal crew running their associations. Some was a function of budget constraints. Some was probably, and I've thought about this a lot over the years, is that some of it was probably they thought, well, we don't want FHA buyers in our complex.
Yep. Probably a combination.
I think
of
it's a
both.
combination of all those above.
And then when you
Because the perception that an FHA loan is for somebody who doesn't have a lot of money.
right,
And that is that's like a,
It's no.
yes.
that's a bad stigma too.
It's, exactly.
It is.
That's
But
not
then,
true.
Too, I know why a lot of those HOAs too, because they make their money off of collecting association
Yes.
dues. But if you had a lot of foreclosures in the association, those dues were past due. They were
Yes.
collected because the banks
Yes.
paid them at closing.
Right.
But if you had somebody 6 or 8 months behind, if you had 10 out of 30,
Their budget's messed up.
yeah, their budget's messed up, so they can't keep up with all the
Right.
FHA requirements.
So what happened was you ceased to be able to do most condo purchases using an FHA loan. So many times I make sure when the condo word is mentioned by my agents, by the buyers, I say, well, send me the legal description, because it's not just an address. You have to be able to look it up properly on the HUD website, which I never leave that to anybody but ourselves because we.
I always look it up.
But think about how many condos you see on the listing. It says FHA, cash, conventional.
You always have to look
Where
it
you
up.
know there's no chance it is. So my brother looks it up. I get him the legal, and he's like, expired in 99.
Right.
Expired in 04. Expired in 2010. Whatever it happens to be. Then you break the heart.
Yeah.
But you didn't break the heart after they got an appraisal or an inspection.
Yeah.
And wasted money, which we see so much of.
Yeah.
You know, people need to
And
be
then
a little
sometimes
more.
the listing agent is trying to fight for that to get back on the approved list. And it's like, okay, well, wait till you get that done.
You do it, you got to do it. Now, my company, crazy as it sounds, has a condo team in Dallas. It's a whole department, and they've got some complexes back on board, but not in the form of a spot approval when you're in a PA.
Yeah.
Right.
It's
Exactly.
when you have a realtor who, for some reason or other, has a few in there
Right.
and has communication with the management company and put them together with our condo people. And between them, they can reapprove a complex. But to get in a PA and then say, oh, geez, let's do a spot approval. Everybody's going to hate each other at the end of the
Yes.
transaction because it's going to
Right.
take
I
12
agree.
weeks, and then it may not work because ultimately they didn't carry enough insurance.
Right.
They didn't have enough fidelity bond insurance. They didn't have enough money put away for the roof
Right.
to get redone.
And you're
So-
talking about the association not having enough
yes,
money.
yes,
Side. So when a buyer pays their monthly association dues, part of that is going into reserves for insurance and future repairs
Yeah.
and improvements.
and so many of them are light on that.
Right.
My condo team helped this one company just upgrade their insurance, and we were
Right.
able to do some loans in the particular complex,
Sweet.
but not inside of a PA,
Yeah.
especially now.
Right.
Who's hanging around for all that, right?
Right.
So it kind of pushes you to you really need to. I've had clients say, "Okay, well, tell me what I got to do because I don't want a house." So I do the credit simulation. I say, "Here's your steps. Come back in 4 months." They come back in 4 or 6 months. They're conventional and they get a condo.
Right.
Some people are not buying a house because they can't take care of one.
Yeah.
So we've seen that happen before, and this may be a good time to transition into other loan products, other reasons why somebody has to go conventional or FHA,
Yeah.
if I may.
Yeah. Just
So let's talk about student loans.
Okay.
I want to jump in your script
No.
No, you good.
because
we do
it
need
ties
to know.
together.
Yep.
These things kind of tie together.
That's
Okay,
right.
so if you want to buy a condo, pretty much you're going to need to go conventional. If you owe $365,000 in student loans, pretty much you're going to need to go conventional. Why is that? Okay.
Right.
So student loans. Student loans play a gigantic part in whether you can get approved for a loan, how much you can get approved for in a loan. And the popular misconception among people is, well, my loans are in deferment. My loans are in forbearance. Okay. None of these things matter to Mr. Fannie Mae, Mr. Freddie Mac, or Mr. FHA. They don't matter. Well, they're going to get forgiven. This is not a thing. This is not related to the mortgage world.
Right.
One day may it be, but as of now, no. So let's just say you're a buyer who has a FHA level credit score scenario. Often people go FHA because you
Right.
can have a 55% debt to income ratio versus a conventional program, which is going to have you between 45 and 50.
Right.
So sometimes somebody with an 800 credit score might get an FHA. Let's just kind of throw that one out there.
Right.
The allowable
DTI.
debt to income ratio is 55%. And if you have a really good file, I've seen them go over.
So in layman's terms, somebody getting an FHA loan may qualify for more because of the debt to income
Yes,
ratio.
because it's more.
than they would on a conventional
Yes,
loan. All right.
55%.
Right.
Versus of your gross monthly income for housing and bills versus conventional, 3% down, which is, equivalent to kind of 3.5 on an FHA.
Right.
You're not getting the computer to go much over 45 on a conventional.
Right.
So you're talking a delta there.
Yeah,
They can buy more.
10%,
So
right.
sometimes I try telling the listing agents when I call on the offers, my FHA buyer is better than the other cat's conventional buyer. Believe me, and my pre-approval's thorough. Theirs is not.
Right.
And he didn't call you this Sunday night like I did.
Right.
So moving on this back to the student loans. So student loans, no matter what, they are going to have to be factored in to the debt to income ratio, FHA side, conventional side. So how are they factored in? Up until April of this past year, we had to take student loan balance, whether it's $7,000 or $365,000, or Angela had a
Which
lady.
we've seen.
Angela had a lady with $600,000.
Yeah.
$600,000.
Yeah. That's 4 houses.
And no chance this lady's ever going to pay them.
Right.
It was, whatever. So we had to count 1% of the balance in the debt to income ratio
So when was this?
up until April
Okay, go ahead.
of 21.
Yes.
And of course, it's not always the deal killer, but it's
Yeah, it's a lot.
a significant impediment. It's a big car payment. It's a Mercedes payment. It's or more.
Another mortgage.
It's another house. You have another. It's like having another house there. So in April, HUD came out with a change that just chopped it in half,
Yeah.
0.5%, bringing a ton
Beautiful.
of people back into
Yes.
the game. It really helped.
When that came out, I was thinking about one of my clients that I closed about a year ago. And I'm like, if this had been out, we wouldn't have had to do, because she had like $230,000 in student loans or something like that. And so what we had to do was call the student loan company 12 times to get them to give you the payment
The
reduced.
income-based repayment, but
yeah.
that is only allowable, only usable on a conventional loan. Now, I don't know the transaction, but I do know that on the conventional side, we have the client call the student loan servicer and ask them to put their loans into income-based repayment and provide a document, which somebody with $300,000 of student loans could have a $120 payment. Mm-hmm. And on the conventional side, we can use that. On the FHA side, we're not able to use that.
So how did I
Still
close
the
all those
0.5%.
FHA deals doing that?
I don't know.
Okay, we'll
Is
talk
that
later.
a lender or a FHA? Is that the difference between one company to the next, or is that a FHA?
Student loans have only been like a very prevalent thing, I would say, the last 3 companies I worked for,
Okay.
which would be Supreme Lending, Mortgage One, and Capital
Right.
Mortgage.
Right.
The rule was the same throughout. So
Okay.
maybe there is somebody out there who's able to use a income-based repayment on an FHA, but I've not come across it.
Okay. All right. That's fair. Yeah. All right.
Okay.
So,
But no, I was just more so commenting to how if that 0.5, if it was reduced, we wouldn't have had to go through all
You
that
wouldn't have
headache,
had to-
because
yes.
every time you have to call
Yes.
Nevian or whomever, you get, they just don't give you what you need, and those documents have to be written a certain way.
What you're saying now, Jonnita, kind of rings a bell, because there is situations where on the FHA side, the 0.5% or the 1% rule doesn't have to be what's counted if the payment that they will now report on the credit report is a fully amortizing payment, which
Yes.
is getting a little bit deep for
right.
Yes.
regular normal people getting a
Okay,
mortgage.
so
But
that would-
if the payment that shows on the credit report is the same as like a mortgage or a car would show,
Right.
instead of there's a line ordinarily. All that shows on credit reports, student loans on the payment section, is a line, little dash,
That means forever.
forever.
Cause just like on your
Yes.
on your
That means forever.
on your
Exactly.
gravestone, when you go to the cemetery, it's you're born,
Yes,
then it's
dash.
the dash.
And we'll
That's what
see.
your student loan
Yes.
is telling you. So it's like graduated 91, then dash.
Dash.
That's what your student loan
Exactly.
is saying.
Okay.
So that's they were probably reporting a payment that was probably lower than the 1% rule would have been.
So if somebody had like say 30,000 and that payment was adjusted, but it was going to pay off over the next 200 years or so, it would
Yes,
say that,
yes,
and they would pay
yes,
on it.
yes,
And
and
you
they
can
would-
use that
Yes,
payment.
yes.
But if it just had 30,000
With no
payment
end.
adjusted and then it just
Yes.
had a dash,
Yes.
Yeah.
That's
All
exactly
right.
right.
Yep.
Many of your grandkids might owe it.
Yeah, it has to be over time. So it normally looks like over 322 months.
So it has to have
Right.
an end date.
Exactly.
It has
Yeah.
to have an end date.
Yeah, it has to
So
have
if
an end
someone
date.
adjusts their payment, it has to have an end date, basically. All right.
Yes.
Cool.
Okay.
All right.
So
I want to ask a question real quick about conventional and FHA. We talked about listing agents, right? So a lot of times we'll show a property and they saying it's only conventional only, and we like this property in good shape. Why are you not accepting FHA? Can you explain from the seller side, explaining to sellers what's the biggest difference between accepting an FHA and conventional offer?
Okay, so really it's incumbent on the listing agent to educate their seller that
Right.
unless they have hanging wires,
Right.
broken railings, significant heaving cement, or their house is way overpriced, any of those things,
Right.
kind of different categories, but those are the reasons why you may be hesitant to take an FHA offer. Otherwise, there is none. If you
Right.
have, I tell the listing agents all the time, is it a good house?
Mhm.
Did you comp it out before you listed it?
Right.
Is there wires hanging? Is there broken cement? Is there missing railings? Health and safety? No. Then you absolutely want to take this offer, especially if it's the in the running numerically with the others, and you get me. Because I actually process the pre-approval, and it's real, and it's going to close. There's no reason not to take an FHA offer if it's a good house. Now, kind of bouncing back to
Well, let me ask this too, because you said health and safety. So whether it's a FHA or conventional offer on the seller side, if there are health and safety issues, conventional loans are
they're
going to
going to
pick
flag
that
it
up
anyway.
anyway.
They're going to flag it anyway. They may get over the cracked cement,
Right,
and they may get over the peeling paint
right,
on the conventional side, but
right.
conventional or FHA, they're going to flag the wires sticking out of
Yeah.
the wall, the railing not on the deck that
Yep.
the child could fall off of. They're going to flag it.
That's
gonna be
exactly
there
what we
either
just
way.
had at a conventional flag. It was stairs. They were brick stairs, and they were, they needed to be redone. And
They're
so
going to
conventional,
conventional is going to nail that too.
they did.
Because I've had sellers say, "Oh, I thought this was a conventional loan. I shouldn't have to do any
It's not,
repairs." I'm
it's
like,
not 89
it's
anymore.
it's still health and safety.
Yes.
That you still got to comply with.
On an FHA, you may get nicked for an older roof, where on a conventional, probably not, unless there's obvious leaks. The age of the roof, they're not going to beat you up
3 to
onto.
5 year
Yeah, they're not
requirement.
going to.
Right.
On a conventional, they're probably not going to focus on that unless something's obvious.
Right,
But old is not going to be the killer.
right.
Now, the one thing that some listing agents probably mention to their sellers is that, let's just say somebody's overpricing a house, which, as we know, over the last period of time, there's been quite a bit of that. Seems to be dying off a bit now, but
Right.
you list the house for a ridiculous number, and you accept an FHA offer, and they bring it in low. Should anybody else come try to buy that house in the next 6 months, that value sticks
Right.
for 6 months.
So On
But-
FHA, the appraisal stays with the
yes,
property.
on a conventional, it doesn't.
Yeah, a new buyer would get a new
Yeah,
appraisal.
and it still
if
could
they
come in low anyways.
Right.
But these are not the best agents who practice this kind of stuff.
Right, right.
Fakers.
Well, sometimes it's the seller. The seller, you're telling the seller, hey, your house is worth between 198 and 205, and the seller's like, I want 210. And you're like, at 210, you may have a shot because the buyer may pay the difference. But when they start saying 225, 230, it's like, why bother?
Yeah,
Right.
You'd be better off pricing
Yeah.
So
it
that's
better
it.
and letting them
Yep.
bid it up to pay the cash. And-
Yeah.
yeah,
Period.
Yep.
Much better strategy.
yeah.
Right.
I want to go back to, I want to explain what goes into DTI.
Okay, let's DTI, which is a term that was never said prior to 2005. There was debt to income ratio, but no one ever threw the DTI out there until the
Right.
mid 2000s. It's really funny. This is the phrase that came about back then. But debt to income ratio, proposed house payment, plus car payment, student loan payment, credit card minimums, divided into gross monthly income. Okay?
Write that down.
Yeah.
Proposed house payment.
I wish I had my post-it board.
Plus, I can recreate this for you anytime you want. Car payment, student loan payment, minimum payments on credit cards equals X divided into gross monthly income, not net, gross. Now, these numbers have fluidly changed over the years. When I started in the industry, 28 and 36, there was a housing ratio,
Yep.
housing plus debts ratio.
Yep.
And it was 28%. Your housing could not go over 28% of your gross monthly income. Your housing plus debts could not exceed 36% of your gross monthly income. Back then, I saw loans that had a 37% debt to income ratio go away to die, very sadly. FHA, that was on the conventional side. FHA was 29 and 41.
Yep.
Okay? So these benchmarks were really pre-automated underwriting benchmarks. VA was 41, 1 ratio. There wasn't a separate housing ratio versus debts added to it, calculated.
There's VA is still weird like that though when
Very
it comes to the
weird.
debts. Like you
Yes.
can almost be at 70%.
You would
On
think
the
they
front
would
end.
standardize FHA and VA. You'd think they'd be
Yeah.
standardized, but they're
No.
not. It's an odd thing. So in the 2000s, when automated underwriting first came about, loans could get through with a 70% debt to income ratio. Crazy, crazy stuff. And that would be one with, a lot of reserves, other good high credit, good aspects to the file.
But I am curious to know, so going back to the VA a little bit, because I do want to talk about that. So we know that, people like to use that because you don't have to put any money down. Do they have a minimum vested like Mishta does?
Well, yes. Well, not exactly. On a VA, if you can
Right.
get the seller to cover the closing costs and the prepaids, and the veteran has full entitlement and can do 0 down, you could do a VA conceivably with 0 out of your pocket, not like a 1%
Gotcha.
rule that Mishta has.
Right.
It would have to be in a kind of a different market than we're in now, or a house that's been on the market for a while. I've seen VA people come with nothing, get their EMD back at the closing.
Yeah.
VA is automatically zero
Down if
It's
you have
just-
full entitlement, if you've not used it before,
Right.
or have paid back all your previous mortgages that you had,
Right.
0 down. But people don't realize, we run into this all the time. I'm doing a VA loan right now that they went rogue and didn't listen to the realtor and go to me.
Right.
The loan officer told them, you don't need anything. Then they needed $6,000.
Right.
So then they came to me, and I switched them from a VA to a Supreme Dream 0 down payment FHA product of ours that allows you to buy up the interest rate from 3.75 to 4.5, but they give him $4,000,
Right.
which brought his amount to close into the range of what he had. Where the other lender, who didn't ever give him a worksheet, no worksheet,
Right.
no worksheet. Worksheet says payment, amount to bring to closing, the 2 numbers that matter. All the rest, the interest rate, the sales price, the loan amount, those are fodder for cocktail parties. Those numbers don't mean anything, they're abstract.
Right.
2 numbers matter. What's the monthly payment? How much do I have to bring?
Yeah.
Right.
Nobody goes to the trouble of making sure that people have these 2 important figures hammered into their brain. So this guy thought he was buying a house. Wasn't buying any house. Was very unhappy that the loan officer disappeared. He went on vacation. He changed company. We hear that
All that. Yeah,
every
yeah.
day. I switched him to a different product with no down payment, forgivable, so he'll have equity. That's
Right.
a much different thing. And again, I bought the interest rate up, which he didn't care. His debt to income ratio is not an issue.
Right.
Gave him $4,000, which made his $5,000 that he has on earth to spend toward the house, got him to the goal line. $9,000 because it's property taxes,
Right.
closing costs, homeowners insurance policy that nobody seems to. The schlocky lenders, what they do is say, well, you'll get a concession.
Right. who's going to
Really?
get a
Right now?
concession now? Right. So it sounds like he's paying a little bit more on interest, but he's bringing less money in up front.
And he didn't care that his payment's $60
Right.
more. He cared about the $4,000 or $5,000 that he didn't have.
Right.
Hold on. I want to explain to them what that means, buying.
Oh, I'm sorry. Yes. Okay, so it's kind of a deep discussion, and I've tried to explain to some loan officers over the years who don't get it. But let's just say, for an example, and this is also, if you ever hear the phrase "no cost refinance,"
Right.
a true no cost refinance is when the lender can get you 4% and charge you $2,800 in closing costs, but instead of that, he charges you 4.25 or 4 3/8.
Right.
That extra quarter to 3/8, depending upon your loan size, garners back more money that the loan officer, an honest one, will give to the client to pay their closing costs, which is, that concept is a no closing cost refinance. Some companies out there take your 200 loan, make it for 207, tell you, yeah, nothing out of pocket. It's a no cost loan. It's not a no cost loan.
Right.
It's a full cost loan that you just raised up your mortgage balance tremendously. What Shaka's question is, so on this particular program, if the people have $3,500 for their closing costs, for example, they get 3.75. Just, I don't know if that's the rate today or not, but it's the concept. So, but they don't have money, and they need money.
Right.
So we can buy up the rate, increase the interest rate, very same concept as on the refinance, and give them a lender credit that they do not owe back and cover that delta that they're short. In this case, $4,000 or $5,000.
Right. So in other words, they're paying a higher rate.
Yep.
They're bringing less to the table. So they can either have their own money and get the lower rate, or they can pay a higher rate and come with less or no money.
It's just like leasing a car. You want the Escalade with a $699 payment. You bring $7,000 to the dealership,
Right.
or you pay the $1,100 payment, sign and drive.
Right.
Same exact
Yeah.
concept.
Right.
So with the VA, do you have any explanation as to why sometimes that front debt ratio can be really high sometimes? Is it just it likes it or it doesn't?
It likes it or it doesn't. It's an automated thing. It's very, very uncommon to do a VA with a manual. It's always automated underwriting, and it depends on. First of all, VA only has one ratio: housing plus debts. They don't have a
Gotcha.
housing and then a housing plus car payments, a separate one. So the front ratio or the can go higher
Maybe
on a
that's
VA.
okay. That's a good explanation, I think.
Oh yeah.
I got a question going back to so you said the honest. So I used to do mortgages. I was an associate mortgage broker.
Okay.
Back in 05, 6, and 7, right? So why wouldn't, because now so back then you could charge almost whatever you wanted to charge on the front and the back, right?
That's where licensing
Yes.
came from.
So
Yeah, I know.
but now you can only you're
Now your commission is set. It's Dodd-Frank,
correct.
LO comp rules, and you set your commission. You can't charge any. It all goes through a portal.
So why won't? So with that being said,
Yes.
even if you're a dishonest loan officer, why don't loan officers buy up the rate more?
I
often?
do. Here's the thing. In a declining rate market, like we were in for a very long time, particularly last year, somebody would come to me, they'd buy a house 4%, pay their closing costs, let's say. Or I would tell them, hey, do 4.25. I'll pay all your closing costs for you, and you keep your $3,500,
Right.
your whatever your dollar figure is. After they made 6 payments, I would call them up and say, hey, it's 3 7/8, an eighth lower than you would have got paying the closing costs. And at 3 7/8, you can go from 4.25 or 4 3/8 down to 3 7/8. I'll pay all your closing costs again, and we'll do it for 29 years instead of 30.
Right.
And and your loan balance will decline, not go up. And I'll show you the worksheet. Here's your payoff, your days of interest. Why wouldn't they?
They don't know.
They don't know.
Those-
They're not smart. Myself and a partner of mine who I worked together with in 1991, and we still work together, another loan officer. way back then, we were sitting in the office, it's 1990, and we're looking at these rate sheets. Because back in the old days, interest rate pricing wasn't done through a portal.
Right.
It was, you got faxes from the different companies you sold loans to. And we're looking at these faxes and we're looking at the pricing that the banks give us. And he said, you know, we could charge these people 6% and they would pay $2,200 in closing costs. Wouldn't it be better to charge them 6.5%, pay all their closing costs, and when rates go down, we'll bring them down. But we are not scammers. We'll actually pay all their closing costs, and on each succeeding loan, the balance is lower, so we're not adding anything in, hiding anything. Here's what it is. Here's your closing statement from last time. Lender credit, covering all the closing costs. So for many years, I always would offer the people the option.
Well,
The smart people.
But you brought up a good point too, because when you said we was talking about bringing less money, having a higher rate, or having your own money and getting a lower rate, I think a lot of loan reps are not even explaining those options. They're just saying this is what you're
Well,
getting.
that's because they don't know.
I don't think they
They don't
know.
understand.
Is that so? My question: that's not always available.
Not necessarily.
Yeah.
Depends on the pricing and how it's working
Right.
out.
Right, and the buyer.
And the buyer and the situation. Now,
Right,
it's not as applicable on purchases
Okay,
because there's not always a rate buy-up.
exactly.
Because the rate buy-ups are heavily tied into credit scoring.
Okay,
Okay,
right,
So,
So-
there got to be a
yeah.
It's the 740 people
right,
that there's more to give because it's risk-based pricing.
right.
And the higher the score, the better the pricing. And giving it back to the people and lowering their interest rate without adding anything into their loan balance
Right.
is very attractive to consumers. And I'm talking now on the refinance side a little bit
Okay.
more, but I mean, I've got so many people who call me, email me, send me their relatives saying, Billy, I retired early because of you.
Right,
You took me from a 6% 30-year when I built my house in Canton in 88 to a 5.5 25-year to a 5% 20-year
right,
to a 4.5% 15-year, then into a 10-year, and I was out of a mortgage so much earlier because you always got a hold of me,
right.
showed me how I can lower my year. So I'm taking years off. I'm not adding to their loan balance. I'm not giving them as low of a rate as if they paid $3,000. It doesn't make sense.
Right,
So if you can go from 5 to 4 and not pay any closing costs, but I really could have got you 3 3/4 and charged you $3,000. Who wants to do that?
Right.
I'd rather have 4 with nothing than 3 3/4 with $3,000 added to my balance.
right,
Okay.
So strategically, sitting there with your loan officer's best friend, a Hewlett Packard HP 12C, which real loan officers use,
right,
we financial planned for so many people and hooked them up. And these are people who are smart at math. These are engineers at the big three and
Right.
Johnson Controls and Lear. And they're like, oh my God, that's the greatest idea ever. And then 6 of their coworkers call you.
So you have to have, so with buyers, they need to really have a financial plan, because some buyers, they're like, I'm just going to ride this thing out for 30 years. I just want the lower rate. And I'll pay the extra few thousand up front. But then if you have something to compare it to, it may make sense to take the higher rate if you're going to plan
Yes.
to do those refinances later.
reductions.
So it just makes sense from the buyer side to sit down with your loan rep and ask questions and have somebody that can educate you.
And so many of them that, that became my clients over the years, they knew that I was
Right.
looking for their best interest, wanted their friends and relatives loans. I'm not trying to hammer anybody. I'm in it for the long, long haul.
You're not getting rich off of one deal.
Never. But you can get rich off a village of people when they all trust you. And you can do a whole subdivision of people.
Correct.
Or a whole office full of people.
Yeah.
You
Right.
know? Now, I had guys who said, well, no, keep putting me back in the 30 because I'm going to invest the difference in my 401k. And I'd say, giddy up.
Right.
We'll do no costs as well, but we'll keep it at 30. And some guys did it that way.
Right.
And some of them said, I got to have this house paid off. So I have less. When I go to retire, my retirement from Chrysler is going to be X. I want to get mortgage free. So whatever their ice cream flavor was that they wanted, I showed them the right way to do it. And there's always a good way of doing it. Mm-hmm. Now, these different options are not always available. Market conditions, credit scoring, equity position, there's factors. And what it comes down to is somebody who does my job the right way.
Right.
As Jake has learned how to do now, we're teaching Steve Crush's purchases.
Right.
He doesn't know the intricacies of all these refis, but that's not what he works on.
Right.
My brother has been working with me for 31 years. He's a refinance expert. He can come up with any idea under the sun. Jake is on every single refi transaction. He's coming across so many of them now because of 4 years, 5 years of turning in his own loans. You sit down and you look at it, and you're not, and I'm not going to pick on the names of any companies or people who advertise a lot or any, that's not what I'm saying, but you have to take pride in your work. You have to sit down with a pencil, a pen, and the correct calculator and look at it and then lay things out for people and say, hey, this is what you might want to think about doing.
Right.
And here's why.
At least let them know they have options.
Yes.
Bare minimum, right?
Yeah.
I got a question. I want to kind of change courses a little bit. So we talked about like the zero down VA, a little bit of MSHDA and FHA. So some of these programs are based for owner occupants only, most of them, right?
All of them.
So let's say, because we have a lot of times, we'll have a client and for whatever reason, maybe grandma or their parents want to add their name to title in case something happens to them. How does that affect or impact the buyer that's buying, but they already have their name on title to another property? Well, because there's a lot of first
only on the MSHDAs.
Okay, on MSHDA.
MSHDA, if you got your title on your grandma's house for her, for succession, if something, you're out. Doesn't matter unless I've had a couple of exceptions where I was able to prove that they never, ever lived at the house.
Okay.
And getting that done is rare because most of them did.
Right.
Mm-hmm. You come across one that truly never lived there, and you was only put on because there was no other family member that could have been. I've got a couple of those through.
Okay.
Now, in terms of all of my zero down and in-house down payment assistance programs, none of them require you to be a first-time buyer.
Okay.
So you could even be in title of another house.
Right.
And we could still work through it.
Cool.
But the MSHDAs, not to pick on the agency because I do a lot of work with them, but I mean, they are hyper stringent and the finest fine print can trip you up.
Right.
So people, this is just a perfect testament for, like I tell every client, the more you tell me, the more I can help.
Right.
Because when this house that you're on pops up a month later.
Repeat that again, because we was just talking about like,
got to give us
just
all
like you work
listen,
with an attorney.
I don't want to say it. I tell them I'm not the mortgage police. Okay, you know, I'm not working at XYZ Bank looking to go, you're out.
Right.
I'm here to coach you.
Right.
The more you tell me, the more I can help you. Be honest, transparent, and upfront with me, and I'll come up with a solution to your scenario.
Right.
But when you don't tell me things, and things pop up after you spent $500 on an inspection, $500 on a appraisal, and all of a sudden we have a problem, remember, you didn't disclose all the information, which we need. Holding things back from me or from you does not help anybody.
Right. So when we talk about credit, like people have blemishes on their credit, there's a lot of people out here pitching credit repair, right? But you guys, as the lender, good lenders should be able to help you get your credit together for mortgage purposes, right?
Well, that's a good thing to bring up. So people say, can you help me fix my credit? I said, well, we can't help you get deletions of accounts. We can't fix your last 6 months in a row of late car payments.
Right.
What we can do is run your credit report through a credit simulator software.
Right.
And tell you what level to bring your revolving accounts surgically to get the most points available. Not just saying, pay off all your credit cards. No. Bring them down, this card down to this card down to this. So we can guide them and coach them, which we do more than frequently.
Right.
I'd say on 30% of our files, we credit coach them. But credit repair, where you use the Fair Credit Reporting Acts, and there's 8 million realtors out there who have this fake sideline of credit repair.
Right. Not us. We don't do
Not
that.
you
I don't
guys.
do
Of course
credit
not.
repair.
No. I know. And
I sell, buy, and invest.
that's it.
Right.
So, but you have these agents who do it, and they want you to refer them people. But the problem is, I'm not going to refer you somebody that a different agent referred to me.
Right.
That's one issue.
Right.
Number two, are you really going to fix something? Well, you're
Right.
going to send a bunch of fat letters using the Fair Credit Reporting Act and hope that somebody doesn't get back to you within a certain amount of days. None of this stuff is real.
Right.
It's all fake. Bottom line is,
You just said what Shaka says. He always say none of this real.
That's what
None of
the
it's
whole
real.
time I've been
Right,
sitting
it's
here. I'm
all
like,
silly.
Billy and Shaka on the same.
none of it's real. It's silly. Okay, so here, bring your revolving down to here.
Right.
Bring this one here. Go open up a Sears card or a secured credit card. Get put on your
Sears.
Your card
Sears
is
you
closed,
can't
and
get
I
a
know
really
it
good
kills
Sears
me.
card.
I love
No,
Sears
but-
so much.
Wait, real quick. So when you said bring your revolving down, you
Your
mean the
utilization.
Debt. So if they have a $10,000 card and they
Then
got a
$3,000 or below.
so like 30%.
30% is the magic number. If you keep your revolving 30% or below, and I just hate to say the word lie. I lie to people and tell them 25,
Right.
and I do it.
Because you know
So,
they're gonna
yeah.
use
Just
a
like
little
telling
bit
people,
between-
yeah, we start at 5:30, but we start at 6.
You know,
I was
tell
making
people
sure
look,
you're
I'm
on
not
time.
alone. I'm saying
Yeah.
I take $10.
I always budget. Yeah, I say
Come closer to the mic,
25%.
too, y'all.
So if you got like a
YouTube
$6,000 max on your credit card, and
Then
maybe they're at 5,000, you're gonna tell them to pay
It's
it
hurting
down.
their points so bad.
Right.
So we tell them, get it
Down at-
25%, 30%, 25%. Use it though.
Right.
Because
Yeah.
you need flow. You need to turn on the sinks and run the water, or it's going to get gummed up. If you want points, you have to have activity. So we tell them, bring your balances down to here. Open up this and that, depending on the person's situation.
Right.
Open up a secured card.
Right.
Charge a tank gas, pay it off. Charge a tank gas, pay it off.
Right.
One of the biggest boosts to people's credit is getting put on somebody's card as an authorized user,
Right.
which really helps. You get report card points as long as they pay on time and keep it under 30%.
Right.
And the older the account,
The
the
better.
longer it's been around, the better,
Right.
more established. Now, sometimes tricky things happen.
It backfires.
Well, today we have a client who's got an authorized user account, and
Right.
we're having them pay off debt at closing to qualify, which you actually can do.
Right.
So we've got her paying off a couple credit cards at closing. So we asked for updated credit card statements. Well, on the one account, she's an authorized user, and there's a very large payment.
Right.
So we can exclude it, but we have to get the most recent statement. Like call the credit card company, have them fax or send it to you right now and get it
Right.
to exclude the debt.
Right.
Well, of course, like every other buyer, they whine and complain about having to provide documents.
Right.
And we had to tell the nice lady that, listen, you got on this account to improve your credit,
Right.
but they have a $350 monthly minimum.
Right.
That's going in your debt to income ratio unless you provide their statement.
Right.
So these things can, I shouldn't say backfire, but yeah, it's one more layer of work that you have to do, but you weren't having a credit score to qualify you had you not done it.
Right.
And you're not getting the house unless you provide the statement.
Right.
Okay.
So, is there ever a time when someone say they have a $5,000 balance on a $6,000 loan, and maybe they got $10,000 needed to close? Have you ever told them to pay down a credit card and we'll figure out your closing costs? So they're using some of their money saved for closing costs
Well,
to pay that debt down.
I try to do that before they get in the PA.
Okay, right.
That's pre-PA. That's pre-letter
Pre-purchase
going.
agreement.
Pre-approval.
Pre-letter.
That's
pre-approval.
Pre-letter. That's pre-letter going out.
Yeah.
Right.
Like if we have that scenario, Rob or Steve or Richie or
Right.
Jake are going to say, well, this account's got to go down to here. And the reason for it would be score.
Right.
So we got to fix the score
Yeah.
before we're handing out the letter.
Right.
So really, you're not going to run into too many of those. And they say, well, that's going to leave me not enough money to buy. Then you got to save
Well,
up
we're
more.
not
You gotta
going to run into that with you, but
But in
we
life,
see it all the time.
yes.
And- yeah.
Yes, that does happen. And, there's solutions to it, but not always. Not every time.
So basically, what it sounds like, a buyer should come to their mortgage rep, a good mortgage rep, and say, hey,
Cards on the table.
here's
Yeah.
everything
What should I
got.
do?
Here's the BS I got on my credit, my income. I had
Yes.
a bankruptcy
Yes.
4 years
Yes.
ago. I divorced, this happened.
Yes.
And tell it all and let you fix it.
Yes, and here's the thing. We get referrals from our realtor partners. And the stronger realtors tell them what you just said. The moving too fast for their own feet and other types of agents will send us somebody who they'll fill out the app, we'll analyze it, we'll request the docs, they'll send half of them or a quarter or a third in photos, which size 72 font it says, no
Right.
photos. Go back and forth with them a few times. The realtor will call us up
Right.
indignant. Why isn't so-and-so pre-approved yet? They're very frustrated with you. And I have to say, well, I'm frustrated with them because they're wasting my time not getting me everything I need to do this right. Well, they've decided to
Right.
make other arrangements. I said, well, okay.
Yeah, but they're going to get
Okay.
the same result if they
Okay.
piece it together.
Okay.
Yep.
Well, we got a big one. Do we have time to talk about one huge thing we didn't talk about?
Yeah.
Oh yeah, we definitely need to talk about that.
Self-employed?
Well,
Yeah.
let's talk about
Oh.
self-employed.
Yeah.
What are you talking about?
Y'all already talked about it before the show started.
No, we,
that's
okay,
right.
well, let's
Plan
cover.
A that
Oh, yeah, we
has-
can do that later. Yeah,
I
yeah.
want to cover self-employment and the FHA 90-day,
Oh, yeah.
180-day
Okay.
rule
Okay.
for
So
our
let's
investors.
do self-employed first.
Right.
So self-employeds, pre-meltdown, and now again, there are programs, I'll call them niche programs, non-agency, non-Fannie, non-Freddie, non-FHA,
Right.
non-QM, not qualified mortgages, where self-employeds don't have to meet the guidelines.
Right.
I don't do those.
Okay.
Supreme has them.
Right.
Many companies didn't have them, including most nobody had them between 08 and 14, right?
Right.
Programs where self-employeds can provide bank statements and show their monthly deposits, but not have to provide tax returns. Now, I don't do those because some of them may work and some of them may not.
Right.
They don't work the same way Fannie Mae, Freddie Mac, FHA loans work, in which you provide your 19, your 20 tax return, your 21 year-to-date profit and loss. The three of them are added together, the bottom line, not the top line. After you subtracted everything and did your write-offs, they add the three together, divide it by 24 months, 30 months, whatever it is, and that's your number to qualify.
Right.
And now you're just a regular old buyer like everybody else
Right.
who gets the best rates, depending on your credit score, gets run through automated underwriting and closes without tragedy and drama.
Yeah.
Right.
Now, when self-employed people come to you, some lenders just want to write up a deal, and they don't care what the carnage is. We, and sometimes it may not be popular, we say, well, we're going to need this. And during COVID, the heat of COVID, it was even more stringent.
Right.
And because we would have to get business bank statements too. But self-employeds, you need 2 years of tax returns and a year-to-date profit and loss.
Right.
The year-to-date profit and loss is their pay stub showing a year-to-date earnings.
Right.
If they don't have those, I gently, politely tell them, I'm sorry, but I don't have a program for you. Because the percentage of those that close using those niche non-QM programs,
Right.
it couldn't be over 30%.
Wow.
Okay.
So
I'm-
I stay away from it, and hey,
You talking about state?
I'm on
I
commit-
understand.
Yeah, stated income, bank statement programs, all those. There's tons of them. We have them. But
They don't.
they're not run through the same portal.
Gotcha.
They're not processed by the same processors. They may go to an outside a bank who does them with higher risk, higher rates. But we're a high volume operation. I'm not looking
Right.
for my processors to quit.
Right.
So I'm not giving them drama files.
Right.
Right.
And I'm going to give you, Angela, Shanika, a pre-approval letter that I hope closes.
Right. Right.
And I'm not doing
He
that.
talking
It's
about
gotta close.
what I've been complaining about. So I've been telling Shaka, it's been since probably 2006 or 7 that I've worked with, like and I know you're a broker, but
We're not a broker.
Direct lender. Okay,
We're a direct lender.
so that I work with brokers, and that I work with, like the non-qualifying
Yeah, I
type
understand.
mortgages. And I'm
Yep.
not saying that they don't close. I'm just saying, since
You gotta have more. You gotta have more Rolaids to have
12 or
those close.
13, I've just only been doing, like what you just said, you provide this, that, and the third, you get your
That's 8 years,
approval.
Jonnita. It's 8 years.
Yeah.
Right.
It's
But
a lot of
that's-
time.
Is
But
your life
and
better?
then when you try, yeah, it is. And when I put something up on my, so I have a little board and I put it up there, I know it's going to close.
Yes.
You know what I mean?
See, I having done this for so long, I've dipped my toes in the water in back
Right.
years, and we'll try this program.
Yeah.
Not in really long years, though. I can't do ifs.
Mm-hmm.
So
I think
that's-
all bottom line, we
I
want to
think-
close our sellers and our buyers.
But this is a lesson though. So you can either have a niche, it may have a lower percentage rate
Yeah.
of closing, but you may have to do a whole lot of them to see what sticks. But what Billy is saying is he has so much business, he gets to choose not to do that.
Yeah,
Yeah.
down in the weeds.
And he rather close the
Them
deals
bad
that have a
weeds.
90 to 95% chance of closing versus a
100%.
30%.
And people who do those
98.
Right.
generally,
Are burnt out.
and there's that, and you know what? All my business comes from, well, of course, past clients, affinity based, but
Right.
realtors who trust me and count on me.
Right.
So why would I, to do 4 extra loans a month, do something that's a roll of the dice? I could never think of
Yeah.
doing it. It's better to say, no, I'm sorry, I can't help you. I'm sure there's somebody is out there that can,
Right.
but I go with the high percentage, not for any reason other than I don't have the expectation. You can't control the outcome.
Right.
You can't run them through automated underwriting. There's not W-2s, pay stubs. There's
Right.
shenanigans on tax returns. And the bottom line is you got to pay to play.
Yeah.
You have
Yeah.
to pay the taxes because the government's giving out the mortgages.
Right.
Private bank products are what does those programs. And you know what? There's withholding on my pay stubs. I pay a lot of taxes. I think people should pay taxes. And I get why self-employed people do what they do and write-offs within boundaries.
Right.
But people who just don't show any income, I'm not doing those loans.
Right.
Yeah.
They write everything.
So we are
Yeah.
getting put out.
Yeah. So one last question because we got to cover something for our investors. So you're buying a home to flip it and you want to resell it. But you're selling it and there's a FHA requirement.
Yes.
So what's that timeline?
Okay, so on the seller side,
Right.
because the mortgages that we do,
Right.
the people have to keep for 6 payments.
Right.
We can't do the short-term financing.
Right.
6 payments is the minimum. But, so say I'm trying to get somebody an FHA loan, and I've got 3 or 4 of these going on right now,
Right.
where the property changed hands August 25th,
Right.
whatever it is.
So that just means that the owner didn't own the property for.
Correct. And it doesn't matter if they
They just bought it or put.
yeah, they put it in their LLC, they sold it.
They acquired
to
it
them
in
and their-
August.
Yes.
Okay.
Right.
So you have to count forward 91 days
Right.
until you can write a purchase agreement on that house using FHA financing. If it's conventional, you can do it tomorrow.
Yeah.
Right.
But FHA,
But it never
you
is.
can't even. It doesn't even qualify FHA before the 90 days.
91st day.
Yeah.
On the 91st day, today was the 91st day for one of my transactions.
Right.
Got the PA today. We've been working on it and coaching it up. And the 91st day, you can write the PA, turn in the file, order the FHA case number.
Right.
Order your two
appra-
appraisals.
2 appraisals.
Buyer
And
pays for one, seller
Buyer pays for
the
one, seller
The
pays
seller
for one.
must
Right.
pay for the second, right?
Buyer can't. And,
Cannot. Right.
once in a while the lender can if it's a big loan.
Yeah.
If there's money in the transaction.
Right.
Or if they do tons of loans with the realtor, which
Right.
they may not care.
Right.
And that's under 180 days.
Under
with that-
180.
With the two
yeah, the
appraisals.
180 is the cutoff where you don't have to do the second appraisal anymore.
Yeah.
Right. All right.
Very common.
So 91 days and 180 days.
Are the two key
91
numbers.
days,
Yep.
2 appraisals. You take the lower of the 2 appraisals.
You take the lower of the 2. Yep.
Right. Right, which we talked
And it
about.
sticks.
Yep.
Yeah.
And it sticks.
It
And it
does.
sticks for 6
6
months.
months.
Yeah.
And at the 181st day, you no longer need 2 appraisals.
Right. Great. All
And
right.
that rule, it shouldn't be so obscure, but I guess just too many lenders and even agents.
Right.
And there's some more in that because you don't have to do the 2 appraisals under 180 days if the sale is not more than 100% or 110% of what you purchased it for, or something like that.
I think you always have to do the 2. I'm to my knowledge, you always have to do 2.
the 90,
between 90 and
No,
180.
Yeah, between the 90 and 180.
Yes.
So and that applies to even if a property changes hands. Because I see people, they're like, oh, I'm going to deed the property to my daughter and then she's going to sell it. And I'm like, no, don't do
Then
that.
you start
Right.
the clock ticking again.
Yeah, you start the clock ticking. So whoever name is in currently, don't change ownership
anything.
in order to sell it. Yeah.
And basically, you, Jonnita, Charles, and Chuck are the ones who know that.
Right.
Nobody else knows
Well,
or
because
cares.
we invest.
But nobody else knows or cares.
But those
Yeah.
are FHA.
Hey, guidelines.
Right.
FHA.
Right.
So you
On the
got
conventional side,
conventional side, you can do it.
sure.
Right.
Mm-hmm.
Right.
but it never is.
Right.
Yeah.
Right.
But it never is.
I think
Right.
we've learned over the last couple episodes that this topic is just, we have to continue to have it because we have so much to cover.
Right.
Right.
And so we appreciate you coming.
Oh, it's a
And we
pleasure.
need to know how we can find you and contact you.
Okay, so I'll make sure you have all my contact info.
You know
you
I
have it
already
in
have
my
it.
phone.
We gotta
And I'd
say
like to
for
hear
the-
from you more often.
We got to
Okay.
say
So-
it for the listeners. that
Okay,
wanna-
so for the listeners here, the first thing I'm going to give you is my cell phone, which Reggie will attest.
actual cell phone?
I aggressively
This
answer
going on
it.
YouTube now.
Yeah, okay. All right. So, hey, call Coach Billy. Call me up, 248-535-0465, or text me. You can also email me at coachbilly@billyslobin.com. That's COACHBILLY at BILLYSLOBIN.com.
You're on Facebook, right?
Yeah.
I'm on Facebook. I'm on Twitter. I am on
You be
Instagram, but I
tweeting.
don't use it. And we're happy to help you. We can refer you to an outstanding realtor partner so that you
Right.
don't get in the clutches of somebody's aunt who does it part-time, because you don't want to do that. In this market that we're in right now, it's imperative that you have a professional team on your side.
Right. All right. And last thing, speaking of team, so when Billy said he used to coach, he still coaches, and you coach your sons.
I coached. Well,
And
I
you
coached.
coach some NFL
I've
players
coached.
too.
Yes.
Some-
So I coached at Farmington Hills Harrison from 1986, 85
Right.
through 2019 when the school closed. During those years, we won 11 of our 13 state championships. I'm actually
Right.
was and am the strength and conditioning coach. Now I'm the strength and conditioning coach at North Farmington High School. In those years, I was fortunate enough to coach, many, many, many great young men. Won a state championship, one of our state championships in 2010 with both of my sons on the team, both Jake and Steve. Also, super blessed to have coached several NFL players. Drew Stanton, who just retired. His last season was with the Tampa Bay Bucks, and they won the Super Bowl last year. Let's see. Michael Ojemudia played for me, plays for the Broncos currently. Khalid Kareem plays for the Cincinnati Bengals currently. Retired guy, Devin Funchess is in the NFL still. He played for me. Chris Roberson, 8 years in the league, played for me. Nick Williams, 10 years in the league, played for me. And then Mill Coleman played for me. Several others. And now the whole coaching staff is coaching at North Farmington High School, a couple of miles away.
Right.
And it's a blessing to have got to spend my whole life,
All right.
working with young kids and trying to save society one kid at a time.
Yeah.
Thank you guys for having me here. We got a lot more to cover, so I'll come back.
Oh, yeah,
Yes,
definitely.
definitely.
If I'm
All right.
invited, I'll come back.
Absolutely.
All right. All right.
Thank you.
All right. Thank you.